working on my notes earlier. What's in the upper left there are three prices that are there. The ones that all sort of run together, those are all in U.S. dollars, and they're measured off of the left-hand axis. The yellow line is the INE contract in renminbi, measured off of the right-hand axis. And then the right-hand graph is actually the change in the exchange rate between the renminbi and the U.S. dollar. During the time period of this trading activity, renminbi depreciated by 7%. Right? One of the things I find really kind of interesting about this, and I still have to work out what I think it really means, is using coefficient of variation analysis on variability, volatility. The yellow line, the renminbi price line, is 50% more volatile than the INE line or returns that have been calculated after having adjusted and converted it to US dollars, which to me effectively suggests that the volatility of the exchange rate was countered enough to reduce the volatility of the domestically priced crude oil in renminbi terms. So there's already almost a natural hedging activity that seems to be represented there. I have no idea if it will continue. I have no idea whether this is an indication that somehow there is a relationship between the exchange rate and the trading activity that has gone on with the crude oil contract. Because this is the first contract that allows for, and is supposed to allow for, immediate conversion to foreign currency. So if all of this 70% of trading that's happening in New York is going on and they don't want to cash out and they want to get their dollars, that would have a potential to depreciate the renminbi. But I don't think there's enough volume and activity going on with this contract to really be responsible for a 7% move. It's just, to me, it was a very interesting relationship that flowed out. Now I'm going to, where am I on time? Oh, okay. I'll go quickly through this. There's not that much data, but I've tried to do with it what I can. I did some simple correlations on the returns series, because most of us know that if we do our correlations on price series, we've often got unit roots, we get spurious correlations and all that sort of stuff. So I used the returns. And what I've looked at here, in part because it gives me the longer series, is a relationship between the INE September contract and the near-month returns for both the NYMEX and the ICE, in part because if we had speculators from this side playing in the market, they were most likely just looking for relative returns, but it also gave me some more data to work with. I put up an old graph. Okay, there's supposed to be a couple little panels that come on here. This doesn't tell you very much. It's, it's a spaghetti line, all right? So what I did, though, which we can see on this graph, is if you think about where these three marketplaces are on the globe in a day, if I'm on I forget what date, May 15th, the first trading that's going to happen on May 15th is going to happen in Beijing. Then it's going to be London, then it's going to be New York. So if I set up my returns correlations so that I have all of these returns for the same dates, then that's effectively saying that China is leading this activity in terms of some level of information flow. And you can see that there is virtually no relationship going on between this contract and either the NYMEX or the ICE. If I make the adjustment and I set it so that New York and London are coming first, we get this. So it very much looks like the information is moving from New York or London to Shanghai, and the information basically gets there, stops, and then starts all over again the next day. Okay. I was sure that I put the right thing on here. That's okay. So I did some really basic range of causality, comes out to the same sort of thing. The flow of information goes from either New York or London. It's really hard to figure out what the relationship is between those two anyhow, but flows to Shanghai and it doesn't go the other direction. Possible reasons for the information flow of direction is that 70 to 80% of the trading activity that's happening in New York anyhow. So it's reflecting views there. But it could also be related to the fact that it's a different crude oil, and it's aimed at a different niche, and one could speculate, and I don't remember now because I've got different slides here than I thought I had here, someplace I say that it could just be that higher quality crude oil leads the pricing of lower quality crude oil, so that could be the part. But also you've got NYMEX and ICE are really well-established, mature marketplaces, and the INE is still trying to figure itself out. This graph basically is showing you the average. It's showing you actually it's the daily shares of trading that happened in the overnight time period as opposed to the daytime period. We see that all of it is over 62% across the way. Part of what could have been extracted from some of the earlier numbers is that the Chinese September contract was basically having 7 trades in trading volume relative to contracts at open interest. All right? And some people might jump right out, and a few people have suggested that this is just all about speculation. This is a brand new contract. Everybody, including hedgers, have to figure out how this thing trades. They have to figure out whether or not it's liquid. They've got to trade in and out of it to see whether they can get in and out of it. Because hedgers don't just buy and hold, they actually adjust their position so that they're keeping whatever they believe to be an optimal hedging position. So I'm not convinced that because we've got this much higher trading activity per unit of open interest on the China contract that it really means that there's excessive speculation or anything like that. All right? I've got a symbol over here that says that I need to stop. But one last thing I really want to point out, and then I'll stop, is for me what matters if we're talking about a hedging instrument is what's the open interest position. Because the open interest tells me what is possibly there to hedge against the delivery month. And if we just do some simple calculations here, I'll make it really short. Basically, the China contract, in terms of open interest, has not yet exceeded 5% of what you would expect to be being consumed during the month that is supposed to be delivered, including the December contract happening right now. And that will also have to assume that every contract that was in open interest was there for hedging as opposed to speculation. So it's not really providing much of a vehicle for hedging yet. All right? Thanks.
Okay, now I'm going to open the floor up for questions, but first I have a couple real quick ones. For Margarita, I was wondering, U.S. exports of refined products has increased over the past several years, and your analysis has shown that our export volumes have increased from both Latin America and Europe towards Asia. But there are a number of refinery expansions and new builds planned to start up in Asia and the Middle East. How do you think that will impact the U.S. exports of refined products?
A lot, and we actually saw, this one's working, but we actually saw in the news a couple of months ago that there was the first refined product cargo coming to the U.S. from Saudi Arabia, so the eagle has landed. So it does change the market for sure, but it's really for the traders eventually. If you're looking from pure trading perspective, taking aside just the fundamental or economical analysis behind it, they will trade whatever barrels that are available and where they can capture the opportunity to make more money.
Okay, thank you. And one real quick question for Madeline. China has just recently imposed a 10% tariff on LNG. It's supposed to go into effect on September 24th. What do you see, like, in terms of tariffs and trade war with U.S. energy products and oil and natural gas? Where do you see the implications? And then I'll open up to questions.
Yeah, it's interesting. I think that when we think about the tariffs on U.S. LNG exports specifically, there's a short-term effect and a long-term effect. And so when we're looking at the short-term effect this winter, in a very tight market, which we are expecting in LNG, just owing to a variety of supplies that we've seen, in a very short market, this is going to, this is obviously going to raise the price for China, but it could have an impact on the prices in Asia, just by virtue of the fact that you have to pay for the option to swap out cargoes, to replace cargoes that, from the U.S. that are going to China, if you decided to do that. But the other thing in the short term is that when it comes to LNG, the U.S. is really the only flexible supplier of LNG, whereas other suppliers of LNG, they basically sold most of their gas and most of their LNG is sold on a long-term contract. And so there's not that much spot availability or volumes of gas that you could trade. So you're relying on the U.S. for those incremental cargoes. And China is the marginal buyer of gas, and so they're going to be effectively setting the price. So if they have a tariff on their LNG in the short term, it's going to have an impact by raising prices throughout Asia. But this is a seasonal effect. So the opposite holds true in the shoulder season. So when the market is long, and we're forecasting the market to start to become quite long from the second and third quarter of next year, just as we have more U.S. projects coming online, and we're also seeing more Australia projects coming into the market as well. And so there, you could potentially see the U.S. just on a purely China tariff basis, not overall, but you could see them shutting in some cargoes because it's just going to be more expensive to produce that incremental cargo because it's produced for the Chinese. Longer term, the impact is more profound because it's, again, exacerbating this notion that there's heightened political risk with the U.S. as a supplier vis-a-vis China. And so even though we weren't necessarily seeing that China would make direct investments in the U.S., it's still problematic for U.S. project developers to have this tariff hanging over. And then finally, it could, when we talk about the U.S. becoming more of a, or we talk about the Henry Hub becoming more of a pricing point in Asian contracts, you could see Chinese buyers in particular, but also other Asian buyers trying to maybe move away in the next generation of contract renegotiations, moving away from the Henry Hub if there's these other sort of trade threats around them.
Thank you very much.
I'd actually like to add a different perspective. I think when I was talking with Ben earlier, that there have been a couple of pieces I read just in the last couple of days that basically say that natural gas moving in the form of LNG is going to be less competitive going into Asia. I don't think that's true at all. It's going to be less profitable in the netback version. But far too many people seem to think that we sell our gas there on a cost-plus basis, which we do not. So what will really matter is against what is the base that China will set that 10% tariff. And if the base is JKM, then the last numbers I ran recently, if what JKM, what, $10 or $11 in the ETU right now, 10% is a little over $1. I could take $1 off of the cost of, or off of that value and still make more money taking natural gas to Asia than I can taking it to Europe. We're not going to stop sending gas there. It's still going to be more profitable to take it there than it is to take it to Europe. It may put a damper, and I agree with you, it will put a damper in terms of the next tranche of projects that come around, but we kept sending gas to Asia and everywhere else all of 2017, and no one was getting full cost recovery for the entire year. We did not stop sending gas simply because we weren't getting full cost recovery. Now we can at least get full cost recovery, just less than what we would get if they weren't going to hit us with a 10% tax.
Great. Now, we have time for a couple of quick questions, maybe one or two.
I would like to comment or question also. Last year, I think it was December or January this year or something like that, we had some Russian energy coming to the U.S. So wouldn't that be a similar scenario? Wouldn't a similar scenario be possible for U.S. energy to just stop somewhere and then we just, change cargo or whatever and then go to China subject to tariffs. Because that's what you see a lot in, for example, in oil.
But the only place that's likely to be able to happen would be someplace already over in Asia. So there would have to be something swapping out in Japan or Korea, because between Sabine Pass or even Cove Point, when you head down, you go through Panama. Now, Panama is importing a little bit, but they don't have enough there. They're going to be able to swap things out. So it's going to have to go all the way across the Pacific and find some friendly player over there with some storage facilities to be able to swap it around. But most of them are still in the destination limited structures, so they can't just take their gas and send it to somebody else anyhow, because someone from Woodside's going to yell at them, or someone at Chevron's going to yell at them for moving gas around.
Peter Hartley from Rice University. One comment on that last point is just that I think the Japanese also rule destination.
For any new contracts.
Yeah, new contract. I was going to ask a question to Madeline. I was interested in the discussion of the alternative, the Venn diagram.
Right.
One that was missing was NBP. And you think of like the Qataris could ship quite a bit to England, NBP based, and work I've done looking at this seems that the JKM is kind of related to the NBP. So it's another alternative, and I guess related to all that is, yes, oil indexation, you've got commodity basis risk, but with the other gas prices that you're indexed to, you've got geographic basis risk, so to speak. So there's a trade-off between the commodity basis risk and the geographic basis risk. So it's not clear, you know, everyone would want to go with.
Yeah, no, you're absolutely right, and that's what we're seeing too, is that there's pros and cons of either. Yeah, I guess I sort of failed to mention all, the number of the benchmark prices in Europe, and we are seeing in these hybrid contract structures, we are seeing TTF and TTF, which is the Dutch title transfer, the continental European benchmark price, which is actually increasingly what we're using to forecast our JKM prices, because NBP is becoming more and more divorced from the continent, sort of the global gas market. But we are seeing elements of those as well.
I had something just to follow up on the point that was made about the Russian tanker. I think that we had a discussion in one of the concurrent sessions. There was a presenter on the Jones Act, and I think the presence of a Russian tanker from far away, drawing on considerably less native gas resources than those that exist a couple hundred miles from Boston, is strictly a result of this regulatory fluke.
Right.
For Dr. Ripple about John Kingston with Freeway. You said there's been no activity in October and November on the contract. Have you seen a rise then on the DME? Because you said basically DME got so hammered in September as a result of this. Has it picked back up in October, November?
Not much in the way of October, but the November contract is. I mean, it's only 3,000 contracts trading there. It never was big, but the November is trading, the December is not. I mean, there's actually been a couple of days this last week where December had zero trading activity, and if it did have any trading activity, it was like 300 contracts trading.
And the other thing is more of a comment than a question. Is just in the past when I've seen contracts launched, if there was a zero in month 2, zero line in month 2, zero line and open interest in month 3, that tends to be a death spiral already having started.
Oh, yeah, I don't disagree. I mean, one of the other things that I didn't have a chance to note, it's on one of the slides, is one of my questions is whether or not it's actually making enough money for the exchange to keep it around. On the best day for the September contract, it made them about $500,000. I don't know if that's enough for an exchange to make it worthwhile to offer contracts going out through 2021 that no one's actually making any use of. But I don't have any particular point of comparison for that.
Omar Cabrales with Firms. Question, there are 4 LNG export projects that have already been certificated by FERC, and as far as I know, they have all permits they need. But they haven't reached final investment decision. One of them has been sitting there for a couple of years.
All 4 of them for cheap.
Why does Why do you think behind that, and what does that say about the future projects that are going to get certificated or who are going to come in front of FERC? What is the future there for the projects?
Yeah, well, like I said, part of the reason that we are not seeing any, my view is, part of the reason that we're not seeing any FIDs is that buyers are not getting nervous enough yet to sign on the dotted line for SPAs, with one key exception, which I will mention in just a second. And so really, the delays in FID, this is a global phenomenon. This isn't just, it's not just in the US, it's just that in order for these projects to actually get financed, we haven't quite, I talked to my banker friends to see, when are we gonna break away from this model where, you'll just finance a project without having a long-term contract. And I'm told that there's all these different options, but at the end of the day, no one seems to want to finance on that basis that, like, yeah, demand in China is going to grow. So that's one issue. As far as the exceptions, it's interesting that the one exception to this lack of SPAs is actually Venture Global. And Venture Global does not have its FERC permitting. It is in the queue, and I believe it's in line to get its FERC permitting in the middle of next year. Venture Global sort of emerged. It's been around for a while. It's a project developer. They're developing 2 large-scale liquefaction plants in the U.S. Gulf. One in Lake Charles, Calcasieu Pass. In the Lake Charles area, Calcasieu Pass, and then the other one is Plaquemines, which I'm not exactly sure. It's
Louisiana coastline.
Yeah, Louisiana, right. And what they have come out with is this modular construct, so smaller trains, and they apparently have some relationship with an EPC contractor that can apparently produce this LNG for under $2 an MMBtu liquefaction cost, which is really sort of upending all of the sort of thoughts about project development around the U.S. Gulf, so including all of these projects that may be financed. And so Venture Global has actually gone out onto the market and said, hey, we can sell you gas for under $2. And no one, I don't want to say no one believes them, because I don't have really an opinion on that from an engineering perspective, but certainly it is to sort of say, well, like at this price, like at under $2, then you have buyers willing to buy. So you have something of a price floor emerging, but really you just need the buyers to sign the long-term contracts. That's what the delay is.
I think we're about out of time, but thank you all very much for attending. And it's good. Oh, go ahead.
Suggest that people attend the general meeting, we always have trouble in the Shenandoah.
Oh, yes. There's a general membership meeting in the Shenandoah room that starts in right now, actually.